Hi, this is Scott Murray. Welcome to the Daily Economic Market Shout for Friday, June 2nd, 2023. It's great having you with me here today. And the jobs report, a blowout. Over 300,000 new jobs in the month of May, right? Another huge beat for expectations. It seems this job engine continues on. And helpful, we're seeing categories like business services, we're seeing categories like healthcare and education doing well. And that really means those categories are generally the higher employed, higher wage categories. And with that, we will see further job gains, and that's great momentum for the economy moving forward. Not surprised about healthcare, particularly because that was weak, and we continue to see that moving forward. But business services, that is the admins, that is the administration, that is the bosses, that's the higher level. That is actually pretty strong, and that's been an area under some pressure over the last 10 years as cost cutting has really impacted. So those middle managers are actually making a comeback, which is sort of another ironic part of this whole area. Leisure, good. Some concerns about manufacturing, and then some concerns about information services, but we've sort of seen those types of things. No blowdown in finance. So again, that's a little bit surprising because of the banking crisis, and construction pretty strong, coming in 25,000 range. So that again is another good sign, even though investment capex has been weak. What are we thinking going forward? I think the good side continues to have some percolations. We saw that yesterday with the ISM number. However, on the service side, I think we continue to see healthy gains, and I think that's going to continue to move forward. Businesses will want to retain employees, even if we start seeing signs as we get towards the third quarter of weakness. So hanging on, that's going to continue to keep the employment stable. That's going to continue to keep spending for the consumer solid. Do want to give a little bit of credence to the household. We did see a negative print there. If we look on the age side, we see it under 20 group and the over 55 were a significant amount of the decrease. So it's a little bit less. It's not in what I would consider the real meat of the area. That's a volatile reading. So that's something we should sort of look for. Maybe a tad bit of an early sign. That's why you saw the unemployment rate move up. Also, we had a little bit of a push towards the pool of labor moving higher. That's another good sign for the market, so that we have more workers out there. So it was a healthy number. Wages continue to be solid. We see the inflationary, I think on the equity side of the equation, you can see good catalysts now that the debt ceiling is over with. There's no real worry about that. So the debt issuance that was supposed to go on, particularly corporate America, and then, of course, restructuring their balance sheets, particularly now that there's some expectations that the Fed will pivot at some point. And so if you put off maturities for a year or two, that would actually kind of help the WACC and the corporate market that moves forward. So that would be constructive for the companies. Fixed income, this inflationary element is probably going to continue to be a little elevated. Probably see that next week in the services ISM number that comes out. Contrast that, we did see some weakness on the ISM manufacturing, which will give us a little bit of break on the good side of the equation. But net, it is decelerating. We should have another quarter of better prints. When we're with those 3 consecutive quarters that we were seeing gains of well over 3%. Those have moved away. Remember, that annualizes up to 12%. Those have pushed away. And so we're starting to get, I think, better catalysts there. But the market is expecting very little inflation, 2 to 3. If you look at the break evens and the market probably not going to get down to that level. I think you'll continue to have this bubbling of green shoots that we saw on the labor market. Through these green shoots, we'll have pressure that continues to be built on the services side for wages, for companies losing employees to new startups, and sort of trying to backfill the wage gains, particularly since, as ADP told us yesterday, the average gain when you move is 12%, and you're keeping your job, it's around 6. So this is Scott Murray for the Daily Economic Market Show. Thanks for joining me.